With growing concerns about inflation in Australia, can we actually see housing prices drop by 20% if interest rates go up? Well, in this video, I want to discuss what causes property prices to go up and down, what my predictions are for next year and the year after that, and what I think RBA is actually trying to do when it comes to inflation. If you're interested in a deep dive into this, just keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because we talk about real estate, cryptocurrency, and financial freedom. Now, this is a very hot topic right now. People are concerned, people don't know what to do, whether it's buy property, sell property, it's a mess, right? Because inflation numbers are now trending a lot higher than what we initially thought. Well, when I say we, the economists and the people at RBA were turning a blind eye to this, but the fact was inflation was always there and now it's hitting the targets for what RBA actually has. This has caused huge concern across the board when economists are coming out and saying,
look at the yield curve, we are absolutely screwed.
And now we need to increase interest rates. This is why we've seen funding rates go up for banks, and that's why they're starting to increase their interest rates for customers. This is causing a lot of confusion and concern. So I want to break it down in simple terms as to what I think is going to happen. Now, spoiler alert, do I think property prices are dropping by 20%? No, I don't. But do I think they're going to increase by 20%? No, I don't. So it's very important just to take a step back, relax, and get educated. As I always say in these videos, it's not financial advice, but it's a prompt for you to start looking in the right places. Now, as we know, if there's any sort of confusion, the mainstream media is going to come out and have a field day. They need something to write about, right? So as soon as they knew that the yield curves were going crazy, funding rates are going crazy, let's start writing about how property prices are going to crash, the boom is over. And then I saw a bunch of YouTubers start talking about the same shit. And I was like, okay, look, I just need to take some time before I go into this and deep dive into it because I wanted to do some proper research. I wanted to know what was happening in the background. And as you know, for these videos, I do a lot of research, but I try and break it down so you're not having to sit here, look at graphs and a bunch of all these other things. And so that it's broken down in a fairly easy to consume way. So the topics I really want to cover in this is why are the RBA changing their mindset from increasing cash rates in 2024 to now in maybe 2022 to 23. I also want to talk about how expensive loans can become with 100 basis points increase. So that's basically 1% increase on interest rates across the board. I also want to talk about if prices could potentially drop by 20% as a result of those interest rates going up and what my closing thoughts are as to what I'm doing in this market. So for so long, the RBA, Philip Lowe, had come out and said,
look, we're not touching the cash rates. We don't care about property prices. We are not touching the cash rate because
really inflation hasn't come into our band. And for anyone that doesn't know, they have a band, a target band of 2 to 3% of CPI inflation. So they go, okay, well, if it's not in our band, I don't really care what's happening in the economy. The problem with that is how they calculate what that CPI actually is. They use a bunch of metrics that are totally outdated and they adapt to what they actually want to do. But we have seen the reason for that is largely contributed to how much government stimulus was coming in. So that's the fiscal side, right? So the monetary side is the monetary policy with interest rates and the RBA. The fiscal side is what the government does when it comes to their budgets, you know, budget surplus, budget deficit. That's what that is. And that's where they can control what happens in the economy because they can open up the printers
and they go brrr.
And then basically what they do is they have money come out into the system. Now, if that happens, there's more supply of money, which means more money needs to go into assets that are already in demand because now your dollar can buy a lot more, right? If everyone else has more, it can buy more. No, it doesn't. It actually devalues the currency. And that's pretty much an example I've shown in videos previously. You can check out a playlist that I have around housing updates that I do every single month on this channel. Now, although we're looking at inflation rates, we also need to look at what the RBA is trying to do. They also want wage growth in the system and they also want unemployment numbers to go down. Now, if there's a gap on those two, then it's just a balancing act. They can't increase interest rates too high and too quickly because what that will do is it means companies that have, you know, borrowed funds and they want to continue borrowing, their cost of borrowing goes up. Now, if they're business owners, they're going, well,
now I can't afford to have more people come out and, you know, be an employee here. I need to let go of people.
That leads to higher unemployment. Most people have home loans. So if the cost of borrowing, their interest rate goes up, then that means they have less to spend as discretionary spending towards,
hey, I want to go out to the cinemas or I want to go out to restaurants and things like that.
Now, right now, people have saved up a lot of money because we didn't really get do much during lockdowns. And now what they can do is they can start spending, and we've seen it already. I don't know about you, but I've gone to restaurants and I've gone to cafes and I've realized prices aren't the same anymore. Lunch specials have gone, and that's because there's so much demand, they don't really need to have incentives for people to come and dine with them. Now, that could change in the near future, but right now people are cashed up, they are splurging out there. What happens when the gravy train runs out? What happens when the free money, no government stimulus is in the system anymore, and the money that they saved up is now all blown? Because we know financial education is not as serious as writing essays about some poet from like 50 years ago.
Please.
So what we need to realize is some people are going to be really smart with their money, invest into assets, go and actually grow their wealth. Others will use the newfound wealth, let go of that wealth and actually go and spend it. Now, if we have interest rates actually increase, the cost of borrowing increases, people can't spend as much. If they don't spend as much, then people don't need to hire as many people in their businesses. So then people lose jobs. Now, I know we're going around the circle fairly quickly, but it's important to realize that interest rates aren't just designed there to increase or decrease housing prices. No, it's to inflate or deflate the economy. It's the economic activity that it covers, right? So if we're looking at why the RBA isn't just going, hey, now we need to increase rates and we need to increase it quickly, is because on the flip side, there is so many other things they need to look at, and it's a balancing act. Hence why I don't think we're going to see a large increase in interest rates fairly quickly. Now, can we see interest rates increase from banks? 100% we can. We're already seeing it. Are they big increases? No, they're not. And we're going to break down what that actually looks like in terms of a home loan repayment scheme and how much more are people actually having to pay. Now, a lot of people, a lot of banks, a lot of economists are coming out and saying, look, we totally expect interest rates to increase by 1% in 2022. Do I think that's going to happen? I don't think so. And the reason for that is because the way that Philip Lowe is coming about this is saying,
well, guys, we need to pay attention that supply chain is not optimized yet.
We have issues, there's no efficiency, and there's still parts of the world that are in lockdown. So maybe the inflation is actually not the inflation that we think it is when it, say, comes to construction costs, when it comes to goods and services, because those supply chains have now been warped, right? Because of lockdowns. So he's expecting that over the next 12 months, we might see those prices ease because those systems, those supply chains will now come back up to full efficiency, and that's going to reduce the cost. The other side to this as well is that you don't want to do this too quickly, because if you do it too quickly and we have surge in cases, or we have some sort of, new variant that comes out when it comes to lockdowns, we could find ourselves backpedaling and then having to reduce rates even further because now we're taking on more debt at that point. So it's a very confusing time to be in the RBA, to be looking at interest rates, because there are moving pieces and they're just trying to keep a balancing act to this. So when it comes to, say, something like, house prices falling by 20%, we've got to look at how much debt is in the system, how much of that is an LVR in terms of the total value of property, and we also need to see how many people are stressed out with their mortgage repayments. The total value of Australian property right now is worth over $9 trillion, but the debt that we have against it is about $2 trillion. So if we really look at that, that's a fairly good LVR. We also need to consider that there's so many borrowers that even if we had a couple of thousand people that couldn't make their repayments, it's such a small amount compared to the larger cohort, which means this is just going to be snapped up by those who can afford to take on more debt. Now, if I'm to go and share my experience and what I'm looking at doing, well, I don't really care if interest rates are going to go up by 1% or if they go up by 2%, because the banks already calculate that when they're giving you a loan. They've already increase their buffer rates as per APRA's changes. They're also looking at increasing restrictions when it comes to debt to income ratios. So they're doing their part to buffer you, because they honestly think that most people are idiots when they take out loans. They're like,
oh, well, I can take a loan out and I'm going to take it for $1 million or $2 million and I don't care about the repayment.
They know that shit's going to fall on them. So they're going,
hey, we need to put buffers in place, otherwise we're going to get screwed with all these houses getting repossessed.
So they don't want that situation. So when they assess, can you borrow these funds? Can you actually do day-to-day activities? And they base it on your bank statements, they're looking at 5.5%, 6% interest rates anyway. So if you've gone from 2.5% to 3.5%, an extra percentage point on your entire loan is not going to be a deal breaker for you. Now, if you've lied in how you've gotten a loan, now you're screwed, because that could potentially play out. The other thing to keep in mind is some areas will lose 10, 15, 20% of their value. This was always going to happen. If you invest into areas where supply is higher than demand, you're going to get issues. But if you look at the right locations, you actually go out there, do the research, and you figure out that it all comes down to one thing: supply and demand. Having this ratio in mind, not just for today, but over the next 5 to 10 years, is going to paint the picture for how you actually build wealth in property. Now, if you are interested in that sort of stuff, there's a link in the description below to actually book a strategy session. Now, this is fairly important because most people enter buying property because someone told them it was a good idea, they buy the wrong property and then they're absolutely screwed. If you want to do this in the right way, you need a strategy, you need a plan. Now, we do offer a buyer's agency service, which I don't really talk about on the channel, but there's a link to my website where you can check out what we actually do, help clients, build their property portfolio as investors, and we base that on research. Now, data is one side of things, and a lot of people come out and say, oh, data is everything, that's what we need to focus on. No, I don't personally believe so. I think it's a mix of the data plus the emotions that bring about the narrative as to how and why you should invest in an area. The thing is, most people are emotional when they buy, they don't base it on data. We need to look at both, and when we combine both, that's when you're gonna get the fantastic results. Compared to someone who just looks at data, it's all lag data anyway, so you're basing it on things from 3 months ago, it doesn't really paint a good picture. The narrative side is talking to agents, having conversations with local people as to what they're doing, the businesses in the area. That combined with the data is gonna give you a really good picture. With the growth that we've already seen across many markets in Australia, it's coming about like it's unsustainable, right? And I don't think we're gonna grow by 20, 30% every single year. We were always gonna see a bit of a slowdown. The big money is made when you're early. The ones that wanted to buy whenever others were fearful, last year being COVID, a lot of people were going,
oh no, property price is gonna fall by 30%.
Now, as much as I would love for this 20% to play out as a drop and crash the market, I've made a video about this specifically why I think, it would be amazing if the market crashes, because then I can go out and buy some more. The understanding here is that some areas will be affected, but those affected areas are probably led by emotional buyers and a huge supply influx of what's actually available. So if you're buying in an area where there's 10 people that are wanting to buy, so the demand, and the supply is only 3 properties, well, even if the 10 now drop to 8, you still have a large influx of demand compared to the supply. And this is going to be very important for when you invest for yourself. When you're looking at investing in property, you need to understand both, and you also need to understand capital growth is not everything. You need capital growth, but you also need the cash flow. So if you're looking at an area and they're giving you less than 4% of rental yield, that's dog shit. You're not going to get so many gains. And I know that yields are compressing, but with interest rates increasing, with people not being able to buy, we could see an upward pressure of rents, and that's why you want to be in the right markets. My final thoughts on it is that I believe that interest rates will continue to move up with the banks, but it's going to be a very careful move, meaning that you can prepare for this well ahead of time. I still believe that the next 12 to 24 months will be the best time to be buying property. And I don't just say that because I run a buyer's agency and all that shit. I totally believe that to be the case. I personally will be coming in after I've done what I need to do in crypto to bring my money in and buy more real estate. The reason for that is because I believe we are part of a bigger cycle, which I think will end and top out in 2025 to 2027, which is when I think we will see a lot of cracks in the system and we will see a larger correction. For me, the next couple of years make sense to be buying in. After that, I don't see it being sustainable with huge amounts of growth. And that's where I think the emotional buyers, the FOMO is going to kick in, and we're going to have this huge influx of immigrants, okay? Immigrants. Immigration and the policy that we're gonna have here is gonna be a huge catalyst to push us forward into the next phase of this bull run when it comes to real estate. If you have enjoyed this video, I know it's been lengthy, but if you wanna get more details around how I break these videos down, I share a lot of this content on Patreon and I break it down with my commentary. So if you are interested, link in the description below, join a community. Really, it's time to get educated. And if you guys have enjoyed this, drop a like for the video and I'll catch you guys in the next one. Thanks, guys.